This video is looking at tabular statements which can appear in section 1 or section 2 of your exam, and we're going to be looking at the 2002 60 marker question in this video, which is on Tobin Ltd. So let's take a read. The financial position of Tobin Ltd on the 1st of the 1st 2001 is shown in the following balance sheet. The following transactions took place during 2001. January, Tobin Ltd decided to revalue the land and buildings on the 1st of the 1st 2001 at €650,000, which includes land now valued at €120,000. February, a creditor who was owed $1,800 by Tobin Ltd accepted equipment, the book value of which was €1,000 in full settlement of the debt. This equipment had cost €2,000. March, received a bank statement on March 31st showing a direct debit of $2,400 to cover fire insurance for the year ended 31st of the 3rd 2002. April, a payment of €900 was received from a debtor whose debt had been previously written off and who now wishes to trade with Tobin Ltd again. This represents 30% of the original debt, and the debtor had guaranteed to pay the remainder of the debt in January 2002. May, Tobin Ltd bought an adjoining business on the 1st of the 5th 2001, which included buildings €150,000, delivery vans €75,000 and creditors €45,000. The purchase price was discharged by granting the seller 150,000 shares in Tobin Ltd at a premium 25 cents per share. June, an interim dividend of 5 cents per share was paid on all paid up shares, so all issued shares. July, a delivery van which cost €16,000 was traded in against a new van costing €22,000. An allowance of €7,500 was made for the old van. Depreciation to date on the old van was €8,200. December, the building's depreciation charge for the year is to be 2% of book value. The depreciation charge to be calculated from date of valuation and date of purchase. The total depreciation charge for the year on delivery vans was €16,000. So you are required to record on a tabular statement the effect each of the above transactions had on the relevant asset and liabilities, and ascertain the total assets and liabilities on the 31st of the 12th 2001. Okay, so your solution should look somewhat like that, and in the exam you will be given lined paper like the one you can see on the screen now. So step 1, lay out the tabular statement. So I'll pause the video now and you can pause the video now and you can write down the figures from the question into your layout. Okay, so step 2, now we record all of the transactions. So January, Tobin Ltd decided to revalue the land and buildings on the 1st of the 1st 2001 at €650,000, which includes land now valued at €120,000. So the land and buildings on the 1st of the 1st were €440,000. So 440 to make 650, you're going to add €210,000 into the land and buildings. And what we're also going to do is we're also going to cancel out any depreciation that had been charged to date on those buildings, and that was €44,000 there. So in total, that is €254,000. And what you must do in your liabilities then is put the exact same amount, 254,000, into revaluation reserve. So that is January done. February then. February, a creditor who was owed $1,800 by Tobin Ltd accepted equipment, the book value of which was €1,000 in full settlement of the debt. The equipment had cost €2,000. So, creditor's debt is now gone. We minus the $1,800 from the creditor. The cost of the equipment that they traded was $2,000, so we take the $2,000 away from the equipment, so we no longer have that. We are going to add back in any depreciation that had ever been charged in that. So there was 1,000 depreciation charged in the equipment, which was included in this minus 4,000. So we get rid of it, we plus 1,000 there. How do I know it was 1,000? Cost was 2,000, net book value was 1,000, so therefore depreciation was 1,000. Overall there, our assets are reduced by €1,000. Our creditors, as I said before, 1,800 are being deducted from our creditors there. We no longer owe them that. And we made a profit then, okay, of €800. So the creditor was owed 1,800, but we only gave them something that was worth 1,000. So that is a profit of €800 there. So both assets and liabilities have minus 1,000. Then we have March, our bank statement. Received a bank statement on March the 31st showing a direct debit of 2,400 to cover fire insurance for the year ended 31st of the 3rd, 2002. Okay, so only one adjustment there. Okay, so usually we might have two expenses or one income, one expense, but we've only got one thing to deal with here. So it's the fire insurance. So paid for direct debit 2,400. So 2,400 is going to be added to the bank overdraft because that is money leaving the bank. Okay, so the bank overdraft is going to be increased, so it's more money coming out. And we have to say to ourselves, right, where are we going to put this fire insurance? How are we going to record that? Well, it is fire insurance up until the end of March in the following year. So that means at the end of the year, you are going to have an expense prepaid. So you're going to have insurance prepaid up here, 2,400. Now you already had insurance prepaid in your balance sheet. So we'll have to take care then when we are doing the 2nd December column. So the 2nd December column is all about what is attributable to the current year. How much insurance relates to this current year? So this 2,400 here is 9 months of 2001 and 3 months for next year. So 2,400 divided by 12 multiplied by 9 is 1,800 for 9 months. And then we add that to the 1,200. So that is €3,000 relates to 2001 altogether. Now, 3,000 insurance paid for the year will reduce your P&L balance by 3,000 as well. So your profit is going to be reduced by 3,000 because of that expense. Now, where do we get the 600 here? That is 3 months prepaid. So 2,400 divided by 12 multiplied by 3 is 3 months prepaid, €600 insurance prepaid there. So that's March done. Then moving on to April. A payment of €900 was received from a debtor whose debt had been previously written off and who now wishes to trade with Tobin Ltd again. This represents 30% of the original debt, and the debtor had guaranteed to pay the remainder of the debt in January 2002. Okay, so we've received 900. That 900 will go into the bank. So that is going to be minus 900 because the bank overdraft is going to be reduced when money comes into it. So that is 30% of the original debt. The debtor has promised that they're going to pay the remainder, so we have to add the 70% back onto debtors. So 900 divided by 30 multiplied by 70 is €2,100 here. The entire debt is €3,000, so that is the whole 100%. So €3,000 goes into the profit and loss, so that is profit. Okay, it's going to increase the profit because it is bad debt recovered. Now, moving on to May then. Tobin Ltd bought an adjoining business on the 1st of the 5th, 2001, which included buildings 150,000, delivery vans 75,000 and creditors 45,000. The purchase price was discharged by granting the seller 150,000 shares in Tobin Ltd at a premium 25 cents per share. Okay, so we put 150 into the buildings, we put delivery vans 75,000 into delivery vans, and we put creditors 45,000. The purchase price was discharged by granting the seller 150,000 shares in Tobin Ltd, you check the balance sheet and check that every share is worth €1, okay? And then that is at a premium 25 cents per share. So 150,000 multiplied by 25% is 37,500. Now, your liabilities are 232,500, but your assets aren't. Your assets are only 150 and 75, so 225. So we have to add goodwill, 7,500 into goodwill. So goodwill is the established reputation of the business that Tobin is acquiring. So it is an intangible fixed asset. So that's May complete. Then we have June. So an interim dividend of 5 cents per share was paid on all paid up shares, so all issued shares. So the issued shares at the minute are 400,000 and 150. So 550,000 shares by 5 cents each is 27,500. They're paid to shareholders. So that is money coming out of the bank. So the bank overdraft is going to be increased by 27,500. And the profit is going to be decreased by 27,500. So overall, we've got no assets, no liabilities here, no impact there. So July then, a delivery van which cost €16,000 was traded in against a new van costing €22,000. An allowance of 7,500 was made for the old van. Depreciation to date on the old van was 8,200. Okay, so let's get started. So delivery van cost 16,000, traded in against a new van costing 22. So the difference there is 6,000. So we add 6,000 to the delivery vans. You can also minus 16 and then plus 22. So put in the two separate figures, that's also fine as well. When we get rid of a fixed asset, we also must get rid of the depreciation on that fixed asset. So depreciation to date on the old van was 8,200. So we get rid of that. The delivery vans already had depreciation of minus 28,000. So we want to get rid of that 8,200. So total assets there, 14,200. Now, how much was the cheque for that van? So the new van was 22,000 and there was an allowance of 7,500 on the old van. So that is a difference of 14,500. So 14,500 is to come out of the bank. So that is a bank overdraft. So it's going to increase the bank overdraft. Now, what you need to do then is work out whether there was a profit or a loss made on the sale of the old van. Now, the old van had cost 16 and the depreciation on it was 8,200. So the net book value would have been, net book value would have been 7,800. So therefore, they made a loss on the sale there, €300. And that goes into the profit and loss account. So a loss, we put the 300 into minus. So altogether, 14,200 assets, 14,200 is liability. Now, the last month is December and it says the building's depreciation charge for the year is to be 2% of book value. The depreciation charge to be calculated from date of valuation and date of purchase. The total depreciation charge for the year on delivery vans was €16,000. So we cannot forget, as always, that we had land included in that land and buildings. So at the start of the year, it was increased, the value was increased up to €650,000. The land element of that was €120,000. So that is €530,000. We multiply that by 2%. Okay, and then we multiply it by a whole year, so that is 10,600 for the buildings that we owned at the start of the year. And then in May we purchased an adjoining business, and 150,000 of that business was buildings. So 150,000 by 2% multiplied by 8/12 is €2,000. So that adds up to €12,600. So that there reduces the value of our buildings by 12,600. And when we think about what impact that might have on the profit figure, that will reduce the profit figure by 12,600. And then we're told that the depreciation charge for the vans for the whole year is 16,000, and that 16,000 reduces the net profit figure there as well. So you can put in the P&L amounts separately. Okay, so you could do minus 12,600 and then minus 16 there as well. So overall, you've got minus 28,600 in both your assets and your liabilities. So that is your December done. And all you have left to do then is do your total column. So you're just calculating everything going over the ways. This year, there was only 2 marks going for that total column. So at the end of it, your assets and your liabilities should add up. So that there should be 1,086,200. So that is the 2002 tabular statements question complete.